Welcome to your Vancouver Real Estate Market update. Today, we're diving into a complex and often contradictory landscape. On one hand, we're hearing whispers of unexpected optimism, even a slight uptick in home prices after a year-long decline. Yet, beneath the surface, the data tells a far more complicated story of weak sales, near-record inventory, and significant affordability challenges. Is this a new phase of market correction, a seasonal blip, or the calm before another storm? Stay with us as we unpack the critical details, examine what's truly happening on the ground, and explore where the market might be headed. Let's start by looking at the overall pulse of the market, particularly the sales activity. For March 2026, the Greater Vancouver Regional District recorded 2,021 home sales. While this marks a 23% month-over-month gain, which is a typical seasonal jump as we head into spring, it's still 2.8% lower than March of last year 2025. Most significantly, this number is a staggering 31.8% below the 10-year seasonal average. Looking at the year-to-date figures for January, February, and March, sales are 14% lower than in 2025, which itself was the slowest year in 25 years. This paints a clear picture. Despite recent small improvements, the market remains very slow by historical standards. In fact, some data suggests March 2026 is among the slowest Marches in the last decade, with only March 2019, when the stress test was introduced, being slower. Now let's turn our attention to the supply side, new listings and total inventory. This is where we see some interesting dynamics. The number of new listings in March came in at 5,792, representing a 22% increase month over month. However, this is a 10.3% decrease compared to March 2025. This reduction in new listings year over year is notable because despite it, our total active listings are still climbing. We ended March with 14,139 active listings, which is a 4% increase month over month and a 1.6% increase year over year. What's truly striking is that this inventory level is 38% above the 10-year average, pushing it near record heights. This glut of inventory is largely a holdover from previous months. If sales were to remain constant and no new listings came to market, it would take approximately 7 months to sell out all the current inventory, which firmly places us in a buyer's market. The Real Estate Board of Greater Vancouver has pointed to fewer new listings as a sign of optimism, and while less new supply can be good, the sheer volume of existing inventory indicates that the balance of power has indeed shifted towards buyers. When we break down sales by property type, a more nuanced picture emerges. For detached houses, March 2026 saw more sales than March 2025, and also slightly more than 2019. This is a positive sign for detached home sellers, likely driven by prices coming down, making these properties more accessible to a cohort of buyers. However, detached sales are still the third slowest in the last decade, indicating a recovery that is far from robust. Townhouses have shown greater resilience, with sales remaining relatively flat and not as severely impacted as other segments. This makes sense as townhouses are often considered end-user properties, less influenced by investor activity. The condo market, however, continues to struggle. March 2026 was the second slowest month for condo sales in the last decade, outside of March 2019. Since 2021, condo sales have been on a pretty aggressive downward trajectory. A major factor here is the significant exit of investors from the market, and until that segment returns, we can expect condo sales numbers to remain subdued or on a downward path. Let's talk about prices, which always grab headlines. In a surprising turn, Vancouver home prices have just increased for the first time in 12 months, according to the Home Price Index HPI, rising by $4,000 or 0.4% month over month in March. This officially ends an 11-month downturn in prices. However, it's crucial to put this into perspective. From a year ago, prices are still down a significant 6.8%. This price decline has actually marked the second longest in the Greater Vancouver Regional District's history, spanning back 20 years, only surpassed by the 16-month decline from March 2018 to July 2019. For detached houses, townhouses, and condos, prices have generally remained flat over the past few months, with any slight bumps being more of a statistical anomaly than a true surge. Condo prices, in particular, are surprisingly back to pre-COVID levels. So, the question remains, is this recent HPI increase a one-off seasonal blip or the beginning of a sustained upward trend? Only time will tell, and we need more data to confirm a genuine market shift. Adding another layer of complexity are the governmental interventions aimed at the housing market. We've seen significant measures, particularly in Ontario, that are being referred to as developer bailouts. The latest involves an $8.8 billion investment into infrastructure over the next decade, with federal and provincial governments essentially paying for water, sewer, and roads, rather than developers. This, combined with recent HSD rebates, could lower the price of a new home by as much as $200,000 on a $1 million purchase. While these initiatives are framed as improving affordability, the cost is ultimately being covered by taxpayers, not developers. These measures are a direct response to immense stress in the pre-construction market, where Q1 sales in Metro Vancouver were down a staggering 97% from the 10-year average, with many projects facing insolvency. The intent is clear: to stimulate and potentially save parts of the industry, particularly given that roughly 8% of Canada's workforce is tied to construction. We are expecting similar incentives to come to British Columbia soon. Beyond local market dynamics, macroeconomic forces are exerting considerable pressure. Oil prices have been setting records, surging over 76% in just 1 month and hitting $111 per barrel. This has immediate effects at the pump, with gas prices crossing $2.19 a liter, but the downstream impact on inflation is profound. Energy prices are expected to add 0.7 points to March's CPI, before even considering spillover into other essential goods like food and fertilizer. With the carbon tax also increasing, the Bank of Canada anticipates a combined 1.4 points added to headline CPI by the end of April. This external shock will reduce disposable income, forcing consumers to divert capital from other areas and creating a drag on the overall economy. Consequently, the Bank of Canada is under pressure, with market expectations pointing to a 92% chance of a hold in April, followed by a 65% chance of 225 basis point hikes by year end. Perhaps one of the most compelling and concerning trends we're tracking is the mortgage arrears rate. This rate, which indicates borrowers missing payments for 90 days or more, just hit a 9-year high in Canada, reaching 0.27% for the first time since March 2017. What's more alarming is that it has increased for 2 consecutive months, a pattern not seen in 6 years. Locally in British Columbia, the rate has increased to an almost 10-year high of 0.24%, marking 3 consecutive months of steady increases. This is a critical indicator because we are entering a period with a record amount of mortgage renewals in 2026. As more people renew at significantly higher rates, the pain of increased mortgage payments will intensify, leading to an anticipated surge in mortgage defaults. We expect the real peak of this arrears rate and its subsequent impact to potentially not be seen until the end of 2027, given its lagging nature. Directly correlated with rising arrears, foreclosures are also spiking dramatically. Month over month, detached home foreclosures increased by 22 and condos by 28. In total, there were 51 more foreclosures this month than the previous, an 11% increase. Since October 2024, when we started tracking this data, total foreclosures on the market have more than doubled, from 230 to 516. This is a rapid acceleration, And when combined with the steadily growing arrears rate, it strongly suggests that we should brace for even more foreclosures hitting the market in the coming months. Finally, let's consider the long-term perspective on affordability. While current prices show fluctuations and some corrections, looking back over the last decade reveals a stark reality. 10 years ago, the average Vancouver condo was $454,000. Today, it's around $760,000, a 67% increase. Townhomes went from $569,000 to over $1 million, and detached homes from $1.3 million to $1.8 million. Incomes, however, have only risen by an average of about $9,000 in Vancouver over that same period, a mere 13% increase. In 2016, buying an average home in Vancouver required 18 times your income. Today, it's 22 times. So, while asset prices are fluctuating and government policies are trying to stop the slide, they aren't addressing the income side of the equation. This means true affordability, even with recent corrections, remains a significant challenge for many. In summary, the Vancouver real estate market is undeniably in a complex and transitional phase. We are witnessing a battle between weak sales and near record inventory on one side, and surprising month over month price increases with government intervention designed to stimulate the market on the other. While there are hints of a potential flatlining or seasonal bounce, the underlying challenges of rising mortgage arrears, increasing foreclosures, and long-term affordability issues, compounded by inflationary pressures, mean that significant headwinds remain. Whether market price increase is a true turning point or just a blip, the market remains fragile and highly reactive to both local and global factors. If you're navigating this intricate market, whether you're considering selling your property or looking to buy, having expert guidance is more critical than ever. Don't hesitate to reach out for personalized advice. Call or text me today to discuss your real estate needs. Thank you for watching this update, and we'll see you next time.